Great. Okay, then let's jump right in. All right. So, the topic of today, as some of you might have already noticed, is what we call shadow carbon financing, how it hampers the green transition and increases climate-related systemic risk. So first of all, to just give you the broad picture, we know in recent years there has been an intensification of regulatory efforts as well as public pressures to foster more decarbonization of our world economy. This has also, of course, included finance, especially since the Paris Agreement in 2015, where there was an explicit mentioning of making financial flows consistent with net zero pathways. However, we do know that the global financial system is operating in a way that is sometimes, hard to manage when it comes to transparency and to steering flows because money is fungible. We have international capital mobility, and we have, of course, opacity and secrecy. So in any case, we would expect that when there is pressure exerted on finance, we would expect certain evasion movements and certain behavior of financial actors to counteract on these efforts. And this is exactly why we started researching what we now term shadow carbon financing. So there has been a bit of thinking out there on this issue. So, for example, what we often find is the term financial carbon leakage. It was also prominently mentioned by the EIA in its World Energy Investment Report in 2024. So financial carbon leakage denotes the idea that if banks get regulated more in one jurisdiction or in an economic bloc like the EU, we will see banks to raise funding likely in other jurisdictions, whereas there's less environmental sentiment or less stringent regulatory environment. However, this has been mostly focused to the banking system, and research on financial carbon leakage is mostly really on the banking system. However, and also there is no real unitary definition of it. So there has not been a lot of research that picked up on this concept. We have also one blog article by James Valcaro, who coined this idea of emissions laundering as a technique that we can see an allusion to money laundering, where we already have this offshore idea, offshore finance component within. However, this term has never been further developed. And then, of course, we have also a report from the Tax Justice Network from 2024, where they speak of green laundering practices of multinational corporations and their corresponding banks. However, what we do not have as much developed in this report also is the idea of shadow banking. And we try to bring all these trends together, really. So, what was kind of the initial spark that lighted our interest? So I think the question I once had a couple of months ago was, how are 28 billion of sustainable finance funds ending up in Saudi Aramco's oil pipeline business? And there was a nice Bloomberg article, which we can see here. It's not a joke. And the answer, to put it a bit more abstract from our academic perspective, was really, it was, of course, indirectly. So we had multiple jurisdictions involved, among others, Luxembourg. There are other examples where there are other known offshore financial centers like Jersey or Guernsey or Caribbean islands involved. However, this was not the only component of it. It was also indirectly via multiple balance sheets and multiple subsidiaries, or in this case, also a special purpose vehicle. So it was a kind of layered chain of different entities. And this is what is typically discussed in international political economy research as shadow banking. So we kind of have these two structural features of the global financial system that in a way are now helping, or in a way utilized to work exactly along these lines of these obfuscation and these counteraction measures of private financial actors that I've spoken about in the beginning. We did our research. We interviewed a lot of financial experts, also regulators, NGO workers, and we, in the end, came up with this kind of classification of our shadow carbon financing channels that are kind of used to either obfuscate financing or give oil and gas firms access to alternative financing. So first, we have the first two channels, which you can see from the logic here on the right side, are rather pertaining to the risk management of banks, especially. So we can see what is called loan securitization. So basically, I take a loan from my balance sheet and I repackage it and I sell it off. We know this from the financial crisis. There's a new twist to it, which is called emissions risk transfers. So they are so-called synthetic securitizations and/or also insurance policies like credit default swaps is also something that we know from the financial crisis, which are utilized to, in a way, remove credit risk or a loan outrightly from a bank's balance sheet. There are some initial suggestions or hints from different sources that this is also it has massively increased in the recent years, among others from the Central Bank of Italy. And what is important to say is that these processes, the special purpose vehicles set up by banks, are mostly set up in so-called secrecy or offshore jurisdictions. This is something we will hear a bit more about later, probably from Alison. The next channels below, as we can see, are what we call alternative financing channels for multinational corporations, or also smaller corporations in firms in the case of the last two ones. So we have bond financing, which of course has the advantage that a bank has to keep a loan on its book, whereas corporate bonds are usually just underwritten, where the money is put up by some investors. This means that the bonds are not staying on the bank's balance sheet, and they are often, or at the time of writing, have not been counted into reported emissions of many large banks, which is arguably an advantage. Carbon asset partitioning is what we call mergers and acquisitions activities. This is more pertaining to equity, but we can see in recent years has been a lot of movement, and we have a bit of data that shows that there's a constant stream of formerly public assets in oil and gas turning private. Then we have what we call offshore corporate wealth chains, which is a bit more in the realm of the Tax Justice Network report on green laundering that I've already mentioned, which means that multinational corporations have a vast network of subsidiaries, oftentimes also in offshore finance jurisdictions, that they can then mobilize to access finance from a variety of actors, and it's often not earmarked as fossil fuel finance, but rather as conventional, or in some cases, even sustainable finance. Lastly, we have two new forms of financing. Private credit, which is increasingly important. It's surging vastly, especially in the United States, which means that basically institutional investors and others can put money directly into fund vehicles that then lend on directly to firms. And on the other hand, we have what is called proved, developed, producing reserves securitization, which means that oil and gas companies can use their oil wells as a pawn and access capital directly, which is then turned into a security like tradable asset and sold on to investors. We can see this also in a second in a graph that we made. Just very briefly, this is a study by the Bank of Italy on what they call round securitization. So securitization of assets that they deem as carbon intensive. We've seen a strong increase in the years up to 2020. This is our what we found on the different sources of fossil fuel financing. Gray are loans, orange are corporate bonds, and we can see that there's a strong variation. It also has to do with other factors like interest rate environment and the business cycle, but we can see that corporate bonds, especially between 2015 and 2020, rose quite steeply when climate sentiments were high. Of course, this is just an indicative factor, but it shows that there are other channels in place where fossil fuel financing can go to. The same is the case for private credit and private equity, M&A. So we saw between 2010 and 2024 a total of 5 trillion of a constant flow in private money taking over assets that were formerly public in oil and gas. And also we can see that private credit has risen steeply in recent years and topped 9 billion in 2020 and 23 alone. So I will rush through the two last slides, coming a bit to the implications of these developments that we can see. So for us, the important point is if we do have a sustainable finance regulation that aims to decarbonize the financial system, and we apply pressure to the banking system, which is already rather well regulated, what we see or what we would expect is a stronger move away from the banking system alongside these shadow carbon financing channels. What this implies, of course, also is that carbon-related credit risk or other forms of climate-related risks are moving alongside these financial assets into less regulated and more opaque parts of the financial system. So the first channel is once more the securitization channel, and the second one here is the risk carbon-related risk transfer channel, and the third one, the corporate bond channel. So what we can see here is we do still have a continuance of fossil fuel financing. However, on the other hand, we see that banks are not really ending up with the risk anymore, but the risk is rather ending up on the balance sheet of institutional investors indirectly via fund shares in hedge funds and other actors, and of course also via asset-backed securities, ABS, that are tradable and that can end up anywhere in the end. And lastly, for the other four shadow carbon financing channels, it's quite complex. You can look it up in more detail in the paper, but we can see that in the very end, it is not staying on the balance sheet of banks nor on the balance sheet of the very fossil fuel firms that are financed, but we can see that there are various channels of how this risk may be channeled towards institutional investors and spread throughout the entire financial system. And this, of course, raises the question in how far this might produce a so-called green Minsky moment or a green swan moment that may in the end well lead to a financial crisis, which we all would like to prevent. That was it from my side. I apologize for the slight overstepping in time I took, and I think I will give the word now to Alison, please.
Thank you very much. Thank you very much, Simon. Thank you very much for having me. I think I can also now share the screen. I will share my screen now and send something in the chat because I will show some figures which you can also look up yourself. You don't need to, I will show them, but in case you want to see them by yourself. So I think you should all see my screen now, hopefully. So thanks again. That was a very, I've read the entire paper, so thanks again for putting this together, all of the authors here. So I think that's really excellent and very interesting work. And my comment is not so much a comment towards the paper, but rather maybe some addition or concreteness on some of the points which have been made in the paper. And I think all of it is kind of starting with a question, which is a very normal question to ask as a quantitative researcher, which I am, which is the question, where's the systematic data here? So I think I asked this question, where's the systematic data? Because there's a lot of anecdotal evidence, there's a lot of interview material and so on. And in my comment, which will be 4 minutes from now on, I'm kind of answering that question myself by arguing that this is the main problem here. The main problem here of all these hidden finances is that there is no data, and I'm claiming that secrecy jurisdictions are the problem here. So, as I said, I will go a little more into detail on the part which Simon has called offshore finance. And what you see here on my screen is all the fossil fuel financing, which is channeled systematically through a specific country. What do I mean by this? I have all the Deutsche Bank fossil fuel financing here, which is actually granted in a country which is not the country in which the fossil fuel company is located. So here on the very right, you see the country in which the company is located. For instance, the United Kingdom, or here Canada has many fossil fuel companies, Russia has some fossil fuel companies. And in the middle, you see the country in which the financing is granted. This is all taken from the Banking on Climate Chaos report, these data. So we see that most of the financing, which ends up somewhere for fossil fuels, is actually channeled through the Netherlands, channeled through the United States, channeled through Switzerland. And what you also see in this graph is in color-coded or a color-coded scheme on how secretive these countries are, or on how secretive you can actually do business in these countries. So the redder a country is, the worse. For instance, the Netherlands, where lots of the financing is actually channeled through, has a secrecy score of 65 out of 100. 100 is the most secretive country, 65 is quite a high number. And this just means that the Netherlands allow many or have many legal details which allow you both as a company and as an individual to remain opaque about what you're doing, both for your finances, but also like very standard data such as annual reports and so on. I will now go to the next figure and just show you what that means for the example of a fossil fuel company. So we've looked into this for Glencore, which is one of the most important coal companies in the world. And you see that Glencore International AG, which is their parent company, is located in Switzerland, in particular in Bar, which is a municipality which is known for very strict privacy law and also favorable tax policies. So actually, this, for instance, means that Glencore does not need to provide details on the activity it is doing in different countries. So we don't even know how much revenue, how much profit, or how much tax this company is doing in different countries, because they don't need to report this here. They have a holding company located in Jersey, very well-known secrecy jurisdiction. All the European financing goes via this Glencore Finance Europe Limited, which is also located in Jersey. And all the US financing is going via this Glencore Funding LLC, which is located in the US. The US is not a tax haven or a financial secrecy jurisdiction throughout, but some parts of it are. And this is incorporated in Delaware, which is a very known US tax haven and secrecy jurisdiction. So you see that this company already is making lots of effort to actually hide what is happening. They are, of course, also using this jurisdiction for other things, but as a result, as researchers, we have problems in accessing data. For instance, in Jersey, a company does not need to provide an annual report, and this is also not public. So you get into all kinds of problems as soon as you try to investigate what is going on here. This is already an opaque structure, which I found challenging to work with as a researcher. But then if you go a little further, you can also find that this structure is even more complex. So again, I'm showing you Glencore here, and the red and orange part is the part which I've shown you before. And this is actually the part of Glencore for which we had these financing data. However, when I look up Glencore in Orbis, which is a paid subscription database with full ownership structures, I actually find that Glencore has many, 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 many more subsidiaries. We have several hundred different firms which belong to Glencore. Now, I don't see any carbon financing for all of these firms in the data. This could either mean they have never received financing or that we don't have these data. Some of the subsidiaries, let's just check, for instance, I think somewhere here, Zinc Funding LLC. It's called funding, so it's quite probable that this is more or less a financial company, but there's no reported loans which are considered fossil fuel loans in the data. So what I just mean by showing this picture is that there's a lot of things happening which we cannot even see, because we might know that there's a connection if we have good access to good data, but then we might not be able to link the loans which are going through all these subsidiaries to the ultimate financial company. And this is, of course, a problem for the public, because this is fossil fuel financing, so it's of high public interest, and we don't have enough transparency to know what's going on. It's also a problem for regulation and supervision, because also supervisors cannot really see if all the rules are taken up in detail. And finally, it's a problem for researchers, because we can just talk about these red and orange parts here and not about all the other parts which are potentially also super relevant for the argument. So thank you very much for your attention.
Yeah, thank you very much, Alison. I will give the word directly to Sebastian, and then we'll open the floor for further comments. So, but Sebastian, here are your slides. Please. That's the wrong one, sorry. There we go.
Yeah, Eva. Well, good morning also from my side. First of all, really congratulations to this very well-researched paper. I think really it is an important contribution to the debate. It sheds light on new forms of transactions that even many ESG experts do not have on their radar. So many thanks for the invitation. I'm of course happy to provide some comments. We agreed to save time for the discussion, so I limit my intervention to three short points that I hope underline the relevance of this paper on shadow carbon financing. Yeah, if you want to know more, you can take a look at the paper I published in December, where I expand on the topics that I'm only touching on now. So the first point I would like to make is the NBFI sector has massively increased its footprint since the global financial crisis, and it shows strong interconnections with traditional banks. The growth of NBFI, thank you, Simon, that you can see now on this slide, represents, of course, a long-term structural trend, but it also results from the retreat of banks in response to stricter regulations. So within the Eurozone, the NBFI sector more than tripled between 2004 2023, and in the same period, the NBFI's share of total financial sector assets increased from roughly 37 to 53%. And this growth will continue as the European Commission attempts to create a capital markets union, which has now been rebranded as the Savings and Investment Union. What I find striking is that the CMU or SIU, however you call it, that this agenda officially seeks to reduce Europe's reliance on banks. However, the intermediation activities of NBFIs and traditional banks have in fact become closely intertwined. And this I want to show you on the next slide. So these are graphs taken from borrowed from the ECB. Looking at the asset side of Euro area banks, NBFI entities on average account for roughly 9% of banks' total assets, meaning that the growth of the NBFI sector is heavily financed by traditional banks. On the other hand, when we look at the liability side of banks' balance sheet, we discover that NBFIs make up around 14% of banks' total liabilities. So the NBFI sector also is an important source of funding for banks. Then the right side of the slide tells us that large banks are more strongly linked to NBFI entities. So in the euro area, 80% of funding, 90% of asset exposures toward NBFI are concentrated in fewer than 20 banks. So we have fast growth, strong interconnections, and a concentration of exposures. All three are sources of systemic risk. However, the regulation of NBFIs and their links with traditional banks has not really kept up with these developments. As Alison said, supervisors and also investors, academia often lack transparency and cannot detect risk. And this is the second point I would like to make. On the next slide, private finance is the fastest growing part of the NBFI sector, and at the same time, the area with the least data currently available. The chair of the Financial Conduct Authority in the UK and many other regulators warn that this opaqueness allows risks to migrate from well-regulated banks to NBFI sectors with lower transparency requirements. And this concealment of risks may exacerbate structural vulnerabilities in the shadow banking sector, be it excessive leverage, liquidity mismatches, or interconnectedness. And as the colleagues at Witten have shown in their paper, this complicates also the efforts to reduce banks' climate-related risks, and it allows stranded assets to pile up in other parts of the financial system. Which brings me to my last point, what needs to be done. Well, first of all, I believe it would be important to require private finance entities to more fully disclose their exposures to banks and other regulated firms. Supervisors need transparency about where the risks lie. Only then they can do their job and ensure financial stability. When it comes to curbing fossil fuel financing, I think there are many potential measures in the area of financial regulation that could be taken. So, higher capital requirements for lending to new fossil fuel projects, or strict limits for the financing of shadow banks, or even reporting of Scope 3 emissions. Another, and I believe more straightforward measure, would be to require large companies in the real economy to bring their business in line with climate neutrality. And this so-called transition planning requirement was included, as many of you might know, in the EU Corporate Sustainability and Due Diligence Directive, or short CSDDD, also dubbed the EU Lieferkettengesetz. So what is the advantage of mandatory transition planning? Well, if companies in the real economy have to phase out their dirty business, then the overall demand for fossil financing decreases, and there is no more need to engage in complicated transactions that conceal climate risks. However, in the Sustainability Omnibus, which the European Commission has proposed recently to cut red tape, it suggests exempting companies from the obligation to implement transition plans. This, in my view, is exactly the opposite of what we need. I would say, yes, simplifying the sustainable finance framework is warranted, but we need to maintain transition planning and other crucial elements that change firms' behavior in the real world. And with this, I'm handing over back to Jan and Simon. Look forward to the discussion.
Many thanks to Alison and Sebastian for great comments. With this, I would open the